So good afternoon, everyone. I'm Virginia Birrell, the CEO of the Australia-China Business Council in Victoria, and we're delighted to have our special guest speakers at this virtual fireside chat. So we have Dr Hong Liang from the CCIC and Mark Burgess from HESTA. Before we start, I should mention that this event is being recorded and it will be available to you afterwards, but just be aware that it is being recorded. Joining the panellists and myself today, we also welcome the co-chair of ACBC Victoria's China Capital Markets Working Group, Stan Roche from Austrade, who will be moderating your questions. Stan's been a driving force behind today's session, and we really thank him for his tireless support and contribution to all things ACBC, and particularly this. We also warmly welcome Australia-China Business Council's National President, David Olsen, who will deliver the closing remarks. I will start with a little bit of housekeeping. If you have any questions, please direct them to the Q&A panel down the bottom of your screen, and we will do our best to get through them as many as we can. We also, as you note, have subtitles on the screen for you. You'll notice my voice is being transcribed, and we are delighted that our new members, iFlyTech, are providing this service for us. Please bear with us. It's the first time we have used this innovative technology. There are a few steps if you would like to minimise this on your screen. You would need to have a look at the 3 option buttons on the right-hand side top of your screen. And if you hover over these, you can click on one which says floating windows. That button has 2 arrows, and you can bring the screen with the speakers front and centre. You should be now able to resize and drag the box around the screen. If you have any difficulties, just mention in the chat section that you're having a problem. Maddie will put up these instructions for you so you can go through them as the speakers are speaking. It's my absolute pleasure to welcome Dr. Hong Liang, the Chief Economist, China International Capital Corporation Limited, CCIC, who's phoning in from Hong Kong to be with us today. She joined the corporation in 2008 and currently serves as Head of Research Department and Managing Director of the firm. Before that, she served as the Head of the Capital Markets Department during 2008 to 2010, Co-Head of Sales and Training during 2011 and 2013, and she is a member of the firm's management committee. It's an absolute honour to have you with us. You obtained your PhD in economics from Georgetown University and your bachelor degree in international relations from Peking University, joining the CCIC from Goldman Sachs, where you served as managing director and chief China economist and co-head of the Asian Pacific Economic Research during 2003 to 2008. You're widely published in both academic as well as leading business journals on exchange rate issues and the Chinese economy, and we are so looking forward to hearing you speak. Also, a very warm welcome to Mark Burgess, who is advisor and the China Capital Markets Working Group. Mark has an extensive global career leading asset managers and owners. He's a senior advisor to industry and holds several non-executive director positions. Mark is an independent chair of Yarra Capital Management, chair of the advisory board of Jamison Coote Bonds, non-executive director of the Northern Territory Infrastructure Development Fund, and on the advisory board of the OMFIF in London. He was previously managing director of the Future Fund, Australia's $120+ billion sovereign wealth fund. Prior to this, he was CEO of Treasury Group, an Australian listed investment company with over $16 billion under management. He's also worked extensively overseas, including as Executive Vice Chair and CEO of Credit Suisse Asset Management in London, Global CIO for Equities and Multi-Assets. He has also held high-profile global CIO roles for American Express Asset Management, Colonial First State, Colonial Group, and Senior Portfolio Management Bankers Trust. A very, very warm welcome, and without further ado, I will hand over to Dr. Liang. Thank you.
Thanks very much, Virginia, and I welcome Dr. Liang, and thank you very much for being available today. There's enormous interest here in Australia in relation to the Chinese economy, not just because of the significance of China to Australia and to the world, but also obviously because China has been going through this phase of recovery ahead of many economies, and it gives us some insight into the process of recovery. So I might ask my first question, Dr. Liang, if I could. How do you interpret the way the Chinese economy is responding to the recovery phase? And can you give us some insights into the Chinese economy as you see it today?
First, thank you. Thanks for having me today. And again, this is not the first time China has experienced this. So 17 years ago, they went through SARS, and they pretty much play the playbook during the SARS time, even though this time I think the biggest difference is the global impact was different, and they would have ongoing export side of the downside pressures. But from what they can do, if we look at what they have done during SARS period and this time, there's not much difference. They started with very severe lockdowns in February, but from early March, with the infected cases started to subside, they gradually reopened the economy. And there's always the industrial activities recover first. And we're seeing just the latest number, the April industrial production numbers started to record positive year-on-year growth. The consumer side, particularly the travel-related activities, even if we look at 17 years ago, it takes about a month to two to fully recover or to start to record positive numbers. So from that side, we're seeing some recovery in consumption, but the personal kind of the high interaction type of consumer demand are still 20% below their normal levels. So again, I think what we're seeing here is industrial activities leading the charge. Consumer activities, if it doesn't involve too much interpersonal contact, that is recovering. Even like travel, domestic travel, we're seeing travel like, let's say anything between 1 to 2 hours driving distance have recovered to positive growth rate already, but any long distance travel, even within the economy, are still subdued. I think at this point, we're seeing the difference again compared with 17 years ago is how the global economy, how the slowdown over there will affect China in the coming months.
And a number of people are observing, or at least asking the question, as to whether imbalances are still inside the economy. And clearly after the shock that China's had, there'll be some short-term imbalances, things like small and medium-sized enterprises, their balance sheets, the employment market. And some have talked also about the potential of inventories being built because the world hasn't had its growth rate come up, that there are these short-term imbalances developing. Could you comment on those perhaps?
I think if I look at the macro, the major imbalances, actually an active shock like this facilitate, maybe force some of the imbalance to adjust even more quickly, like 2008, the export shock from the global financial crisis actually started to accelerate China's reduction of dependence on exports. I think for China this time around, we're seeing the rebalance, first is maybe less dependence on export demand, and second, within domestic demand, this shift towards more consumer driven rather than investment driven. I think on that note, in the very short term, the imbalances may be getting a little bit bigger just because the government has to step in to plug the hole of aggregate demand shortfall. So we're seeing the major, the one of the engine that drives the recovery at the moment is still infrastructure related. So I think from that imbalance perspective, this is as we see in other parts of the world. This is a very negative public health shock, and every government started to do whatever they can to pump up demand and to reduce the losses of unemployment. So if we see that as imbalances coming up a bit, this is where a lot of the advisors and researchers are watching how much China is going to use the old playbook of using infrastructure, using banks to pump up the economy. I would see they're more reserved this time and more careful this time. But as we have seen everywhere else, if the negative impact on the economy, particularly on unemployment, lasts longer, the government will have very little choices in the short term.
Yeah, thank you for those comments. I think close watchers have been probably impressed actually that the policy response has been measured, considered, careful, classically strategic while also dealing with the short term. We've obviously got the National Party conference coming up this week. It's getting a lot of attention. And we've also seen, and close watchers of the PBOC have talked about some changed wording there. I think initially the PBOC talked about not having extreme measures, but some of that wording has come back to perhaps a more active approach to policy. It does seem to be pointing towards some policy response here in the short term. Would you like to, and it is a speculation, but perhaps speculate a little bit on what policies we should be watching out for?
Again, as you said, everybody noticed the Chinese response this time is more measured because I think the lessons, the soul searching from the last 4 trillion stimulus in 2008 made a lot of people concerned. First, the magnitude of the stimulus, and secondly, how the stimulus was delivered. Last time it was mostly through the banking channel. And thirdly, the composition of that stimulus. Back then, it was almost 100% infrastructure spending rather than anything that directly supports the company's particular consumer and small medium-sized company. So I think that if we look at the response so far, at one hand, the government keeps emphasizing they have enough policy room, they have a lot of tools available. At the same time, they're fairly careful about not using the bulldozer or using all the tools at once. They're more in a mood like wait and see. So I think the National People's Congress Party that is, I think it's going to convene on Friday. A lot of people will be watching for whether they will continue to set a growth target or whether they will tone down that, at least for this year. And secondly, there will be explicit government deficit target increase, and there will be special government bond issuance, but people will be guessing, how big that is. I think so far the expectation is very measured. We're talking about 2 to 3 percentage point of GDP. But I think at the same time, the market understand the Chinese government has a lot of more relatively policy maneuver room compared with other countries. So if needed, they could use more.
Yeah, it's certainly a very interesting period coming up for all of us watching the Chinese economy closely. As Virginia mentioned at the start of the presentation, we're very much encouraging questions today, and Stan will be asking those. But I've got a question that was sent in a little earlier from one of our largest asset owners, so I'll just read it out. Given the short-term impact of COVID-19, what are the major long-term economic consequences of the pandemic, in your opinion?
It's just my observation, understanding, like a negative external supply side shock like this, they usually don't change directions of major macro trend, but they tend to accelerate certain trends. So from what I can observe and see, I think people notice the long-term impact. The biggest one I'm personally very interested in watching is this continued shift of more reliances on domestic demand and less dependence on external demand. And within the domestic demand, the composition, the rebalancing is again towards more consumer demand. So I think this episode will, particularly in the next quarter or two or even longer, I think China will face a very weak, muted external demand that will force the government to look again deeper in their policy tools, how they could facilitate that transformation. And secondly, I think a lot of people notice that the automation, the more use of online services, that trend would continue. I think what is being more debated is whether supply chain, because of some of the interruptions, whether that will be moving away from China. Actually, if 17 years ago the SARS episode was any reference, I actually think that I actually don't think so. I don't think that will be a long-term macro impact. So for me, I think for China is this shift towards more domestic consumer-driven economy, and the technology side more automation, more tech-heavy, that are going to be looks like long-term impact from this episode.
I think you've taken my next question, but it's interesting that every call that I've been on in the last couple of weeks, there's an absolute consensus that global supply chains are going to change. Now, I always worry about consensus as an investor because it's often doesn't come true. But there is this discussion about global supply chains. You've talked about the changing nature of the Chinese economy, and I would certainly encourage people who don't follow it closely to look at the difference in the way the Chinese economy has become structured here. But just on that very direct point, and you've somewhat answered this, but how much impact, how much can the Chinese economy withstand the changing nature of, or potential changing nature of global supply chains?
I think we have talked about this at least since I joined this industry 17 years ago, actually, exactly. Again, what we have seen is a business will try to deal with the vulnerability in their supply chain, but at the same time, they will do it in a resource efficient, economic way, commercial way. And I think a lot of the analysis so far, or the consensus here to me, seems a little bit to a lot of a partial static analysis. I think, again, if we look at why certain supply chains have been centered, have been built in China, 10 years or 20 years ago, it was cheap labor. And nowadays, I think the biggest word I would just put down there is the scale of the what China's supply chain means for all the manufacturers. And secondly, what has changed in the past 10 years is China increasingly become the largest market. So again, the scale from the supply side, but scale also from a demand side. I think that is very hard to change from an economic commercial perspective. But of course, every industry, every business will try to deal with the vulnerability they have detected through this event, and they may want a little bit more diversification, a little bit more network type of supply chain. But I don't think if the concern is supply chain moving away from China, I think that is just looking at maybe one or two variables and missing the big picture here.
There's obviously been a number of documents released in the last few days about the nature of the socialist market economy and some planning around future changes, obviously ahead of the dual meetings, and certainly I found them very interesting reading in preparation. It'll be interesting to see what comes out of the upcoming meetings. But perhaps not commenting directly on that, because there is some stuff to read there for everybody if they're interested. But just in terms of the overall growth rate, do you think that the upcoming meetings will seek an opportunity to perhaps continue to reset the growth rate expectations going forward over the medium term?
Well, I think they, again, firstly, I'm not a big believer that China's success depends on the planning. I think there are too much credit given to the government planning side. Actually, I have much more faith in the dynamism at the private sector, at the grassroots. But from a planning perspective, the Chinese government tends to have those really long-term planning that actually usually spans over decades. So their growth target has already been set. This is set in 2017 at the 18th Party's Congress, 19th Party Congress. They basically set the growth target until 2035. And that growth rate is on average about 5% in real terms. So for the next 5 years-ish, we think the growth target will be getting close to between 5 to 6, because in the next decade, the growth rate will trending probably between 4 to 5. So I think, again, there, if a lot of people notice the planning in China is not just a 5-year plan. It's actually cross even leadership's generation. It's usually they have those 20-year type of growth target. Whether they can achieve that or not is everybody's analysis. But I think from a planning perspective, it's very clear. And just for this year, I think that advice given to them, and looks like they may tone down this year particular growth target. But if we look at 12 months ahead of us, I think they will continue to shoot at growth rate at 5 to 6%.
Dr. Liang, I think what the other thing that's been interesting right through this period, while the Chinese government has been managing the economy, managing the scenarios, they have been making a number of continuing announcements about financial markets liberalisation, access by foreign investors. I got the opportunity to speak on this last year in Shanghai, and it is interesting. This is a very clear plan that has a very clear direction. Could you maybe comment on what is going on there in terms of financial liberalisation, opening the market to foreign investors, and some of the more recent announcements?
Yeah, again, capital market has been mentioned as very important in improving China's resource allocations. But if we look at the progress made, we oftentimes found that the progress is accelerated when they have true economic pressures to do that, whether that pressure comes from within the economy or externally. So we think opening up the financial markets to more foreign investors has started to have pressures both coming within China and externally. Within China is, again, China overall is not so much talking about growth rate, but they're talking about upgrading, better quality. And to do that, they needed help from capital markets. They could not just so much relying on directed bank lending. And I think there's another imperative coming, that is the external pressure from particularly the US, all this mentioning about restricting Chinese companies listed in US, or not allowing US investors to invest in Chinese companies. So again, if I look at it on that front, the imperative for them to have a more functioning capital market onshore becomes more important, and the lesson the lesson they really took to heart is when they open up a sector, they actually get better. If we look at the manufacturer, but for the financial sector, a lot of the problems they're facing was because the system was relatively closed. So again, I think as you said, the policy directive has been mentioned for years. But I think this time around, we're seeing a lot of really domestic need is in their own interest to push forward on this.
Just looking then in my second last question on asset allocation into the markets, and I think this has now been publicly announced, Dr. Liang, that you're about to make a move to Hillhouse Capital, a firm that is very well regarded here in Australia. And in fact, a couple of our large asset owners have funding with them, and this is in the private equity space. But this is clearly, perhaps you could tell us a little bit about the opening of options, but also why private equity, for example, is an area that obviously is attractive to you as well, and its role. And I was speaking at a conference at the West Lakes Alternatives last year, and it was very interesting that private equity was talked about as a kind of a leading edge area that'll enable the improvement of the efficiency of the Chinese economy. So perhaps you could just touch on the opportunities for people in terms of allocating towards China.
Again, firstly, I have for years arguing that China should be a separate asset class rather than part of anyone's just emerging market allocation, given the importance of the economy and given the benefit and destructive forces China, what happens in China affects the rest of the world. So China should be an asset class, whether it's the equity or the bond or currency. When it comes to equity, actually Hill House has a larger asset under management in public market. So they are actually looking at the whole capital structure, equity capital structure. They are in VC, PE, and public equity. I think that the attractiveness of private equity is particularly for China, when the domestic public market doesn't function well, for money that can take a little bit more duration risk, we have seen better returns. And there are certain long-term macro trends that are unlikely to be interrupted by short-term volatilities. So again, the track record of some of the leading private equity firms, their performance in the past 2 decades have impressed a lot of investors, both inside China and outside China. So again, I think looking at this is there are certain long-term trends are not going to be interrupted by COVID, are not going to be interrupted by this current confrontation or conflict with the US, and where would you want to be positioned in that? And given actually China's influences, impact for the rest of the world is only increasing, not decreasing, even for your own domestic, wherever you invest, you probably want to keep an eye on what is happening in China. And the better place to keep an eye on that public market, private equity, even VC funds. So again, as Hill House founder said, why we want to be in VC is because we want to see where some of these creative disruptors, what they're doing and how they're positioned.
So my final question before we go to questions that'll be overseen by Stan. My final question is, you mentioned about the economy itself, and I'll put you slightly on the spot here. It's clearly recovering, but it's perhaps not back at 100%. I think that's a fair comment, and a lot of this has to do with the nature of the global economy. But if you said the economy was at 100% prior to the COVID situation, roughly where do you think the economy is in broad terms if it's functioning relative to 100? Is it at 90, and whereabouts is that sitting? And the other game that, of course, financial markets are always trying to work on is 12 months forward. When do we go back to, let's say, a more normalized global economy, including China, in your opinion? How does that path look over the next 12 months? And it is an estimate, but what's your best estimate?
Again, this is at CICC, with our research team. A couple months ago, we launched this China Activity Index, exactly trying to get a gauge actually on daily basis where they are. It's kind of like capacity utilization ratio type of thing. I just, before I get on this call, I was just looking at the reading yesterday. It was 94.7. So roughly 94.7% of a normal level. But again, that normal, keep in mind, is not zero, is roughly a 5 to 6% growth. So we are still below normal, but again, the economy started, many of the macro numbers started to record positive growth rates year on year even. So assuming we don't get the COVID virus to turn into something more nasty, and assuming we don't have a large negative second wave globally before any vaccine or treatment comes in, our trajectory or my best guess is they will start to record positive 5-6% growth rate in third quarter onward. And the output gap probably will be closed by the end of the year. This is a function of government support. A lot of the stimulus are being released. Secondly, also relatively, again, the COVID has done limited damage on the Chinese economy. The shutdown was relatively short period.
Thanks very much. It's a fantastically more precise answer than I expected, but I know there's a lot of terrific indicators available, and we're also hearing very similar things from multinationals and others that are engaged from different perspectives. I'm sure those sorts of data are also included in your more short-term indicators. So I'll now hand back to Stan, who's been monitoring the questions, and hopefully we have a long list there. Stan, I'll hand over to yourself.
Thanks, Mark. There's a few questions in there. Can you hear me, Leon?
Yeah, I can.
Thank you. The first question is, China is adopting some measures to stimulate the long-term economic development, including promoting a freer liquidity of the factors such as labour and land. What is your view on these measures, and how much effect do you think it may have to the economy?
Again, as I said, this is probably, I will give you a long-winded answer here. Since 2008 or even before, the transformation or the rebalancing, the biggest macro rebalancing that I think is going on in China and affects the rest of the world is how China will need to, the growth needs to be more domestic demand driven. And within domestic demand, how could you do this with actually investment growth not leading as the engine, but more consumer demand? And even with investment demand, how could you do this through a more market-driven way and more private companies' participation rather than only SOEs? So all along, people notice what major factor of production is not market determined, and people have pinned down their kind of fingers on labor, land that has not so much been free market allocated, and a lot of that has to do with the hukou system. So we have talked about this for almost 15, 17 years, and we're seeing progresses each time when actually the exports gets into a major hit. So this time around, the COVID, I think the Chinese government everybody thinks this is still short-lived. But if we look at some of the issues with the US and with the external side of the relationship, they need to work harder to make 1.4 billion Chinese people consumers, rather than only 400 million of them are today truly consumers. So this comes back when we talk about free flow of factor. This is really where you look at what is not freely allocated is the due track land system and the due track labor or hukou system. And I think this, again, people are looking at some of the experiment efforts that are being done, mainly surrounding the big cities like Beijing, Shanghai, some of the more fluent areas, whether we start to see some of these changes to make, if they're successful, we wish to see consumer demand not just resilient, but actually strive. So again, this is in that backdrop. The government probably are anticipating quite a long period or multi-year challenges to how can they maintain 5 to 6% growth in this kind of external environment.
Thank you very much. That's a great answer. Another one is, there is concern on the back of globalization. How is your projection towards the end of that trend? And how should multinational companies from Australia and China be better prepared for the potential upcoming changes?
There are a lot of discussions about globalization, just like supply chain. A lot of people say that, oh, it has peaked and it will reverse. My view is, I think this is too early to tell. Globalization certainly brought a lot of benefits. I think the major challenge is the distribution of the gains, both domestically and internationally. And we're seeing for example, the US, a lot of the issues maybe the gains from globalization are so much concentrated in a small part of the economy. And I do think multinationals bear some of the responsibility for that. So again, going forward, how development in globalization can be made more inclusive and deliver more gains to the broader community, I think that will be the challenge. And for China itself, I actually think they have done a relative better job in distribution in the last 5 years. And they seems to be more paying attention to that. So I think for multinationals, I think concerns for distribution, income, wealth, that has to be part of business strategy. If not, I think the backlash we have seen actually has been increasing. It's not beneficial for even the business over the medium long term.
Great answer, thank you. There's a couple of questions here. One is, what do you think of the negative impact of some of the Chinese firms and potential fraud that has occurred lately, particularly someone like Luckin Coffee? And another question by the same person was the impact of the US stimulus on other market currencies.
This is two questions. I think corporate governance has been a concern for a lot of investors in investing in equity in China. This is not just companies listed outside of China, because at CICC we work with most domestic investors, and a lot of domestic companies are not investable because of the corporate governance issue. So again, to put it back in the big background here, if China really wants a functioning capital markets, they need to tighten enforcement of existing corporate governance rules and regulations. The Chinese regulators have put a lot of rules and regulations, but enforcement has been not up to the expectation. And there are certain rules and regulations needs to be changed. For example, domestically, certain corporate fraud gets very minimum, if at all, any punishment. That has been getting a lot of public outcry. And we're expecting, hopefully, the National People's Congress this time will start to push through some of the more severe punishment for corporates that listed in China that has already committed fraud, but they are getting away from it just because we don't have laws to give them the adequate punishment. I think for like saying some of the external listed company, again, that's probably an area some more cooperation between China and the US regulators are called for. So again, I think corporate governance is going to be an area both the Chinese regulators, but also a lot of investors will push further progress on. As for the currency, this is highly debated, and we are still not out of the COVID shock yet. During a market shock like this, we tend to see liquidity tightening globally, and in this backdrop or environment, actually dollar tends to be on the strong side, particularly vis-a-vis emerging markets. However, if we pass this period of liquidity tightening or squeeze, I think some of how each country has responded to the COVID and how they exit from the stimulus, and of course, at the same time, the ongoing structural side of changes of any particular economy, those will determine over the medium term, long term, the currency, the exchange rate. I think is if for the currency I observe most the RMB and the dollar, I think people started to not have in the past few years it was a one-way kind of bet that the RMB would depreciate vis-a-vis the dollar. I think at this point is a more open question. Again, there are data, there are certain indications that if China handles this COVID better and the stimulus delivered is relatively more targeted and efficient. Of course, if China could achieve some more progress on structural reforms, RMB actually over the medium term potentially have appreciation pressures.
Thank you. Thank you. One final question I've got here from one of the is, you mentioned that infrastructure drive is always the first stage of any economic recovery in China. What would a second and subsequent stage look like? And when will that occur? And do you have any view of the strategy that would be adopted?
It's interesting if I just watch for the high frequency data, what has been, which atom macro kind of a commodity has started to record a very strong year-on-year growth. Actually, it is steel at renewal prices. And if you look at what type of steel, it was in high demand. It seems to be very much related to construction. So again, infrastructure investment in times of like this, when private sector are more cautious, this is always the fastest, the most effective jump starter the Chinese policymakers use. And usually with it, we're seeing property demand started to recover. In the past, the property demand recovery usually has something to do with the easing financing conditions or even easing restrictions of mortgages. But this time, we haven't seen much easing on that side, but we still see property demand seems to be on demand. I think the reason is, again, for Chinese infrastructure, a lot of that is still related to urbanization. A lot of that is still related to pushing for hukou reform, pushing for more migrant workers to transform into urban residents. So by itself, it still involves even the public side building, maybe public housing, maybe upgrading the old housing stock. So again, this too, so far, we're seeing fairly clearly, I won't say a V-shaped, but almost a V-shaped recovery. And usually with that, auto will come. So if we're talking about big ticket items, this is again part of the same underlying driver of income, demand, liquidity. So again, what drives China's growth at this stage is still is a lot of urbanization related. Property, auto are still the two biggest purchasing items that are very high on people's purchasing list. The other recovery we should start to see are some private sector investment. So assuming, again, we don't have a large negative wave hitting China, and assuming some of this stimulus this time around is delivered better and more efficient, we should see private sector investment stabilizing and even picking up in certain areas. So one of the areas that China realized they need more investment is in the public health area. And the whole area, there are a lot of subsectors. Private sectors have been active about. So for example, even facial mask production, the majority of producers are private sector. So again, if I look at the the more cyclical volatile items in demand, the next item I will be keeping an eye on is how quickly private sector demand stabilizing and even picking up in certain sectors. Consumer demand at the end of the day is going to be following with the overall macro trend.
Thank you. Also, the other misnomer with one of the new regulations surrounding the Chinese real estate investment trust market is that it's not really targeted initially at real estate per se. It's targeted at infrastructure. Do you think that's going to give good infrastructure investment a boost?
I think it's because real estate was so controversial, but the need for China to launch the REITs market, the real estate trust asset class, is so overwhelming. I think this starting with infrastructure, some of the project is, in my mind, is a compromise. So they need to get the product, get the asset class started, and they couldn't do it with real estate because they're not ready to really launch large-scale public housing yet. So they basically test the water using some infrastructure projects. I would expect if they really want this asset class REITs to be a meaningful asset class and to really serve its role as in between bond and equity type of capital structure, at the end of the day, real estate should be a significant part of that asset class. And for China, I think the major candidate for that are two types. One is public housing. The other are a lot of office holdings within the SOEs, even with the government itself.
Thank you. There's before I add one question, you're sitting in Hong Kong. One area that Australia's not very familiar with is this huge economy that's taking place with you and next door. That's the Greater Bay Initiative. Tell us about how that's transforming China and particularly capital markets such as Hong Kong versus Shanghai and Shenzhen.
Well, originally when we the Great Bay Area actually is basically Hong Kong, Macau, and Guangdong. So initially we heard maybe one of the major consideration of getting the Great Bay Area project was to try to include Hong Kong, Macau in the Chinese growth and try to also utilizing those two places to open up Guangdong more. And so using Guangdong as an experiment to really even opening up some of the capital markets here. I think as where we are now, the progress seems to be made mostly on the Guangdong side. So Guangdong itself, they still have pockets of local government, even like Hukou, transportation are not fully connected. But under this initiative, there's better planning, there's better labor capital mobility, and there's better, again, just infrastructure-wise, much better planning. And Macau has been fully integrated in this project. I think Hong Kong, given what we know happened last year, it was a little bit more tricky at the moment.
Okay, thanks. We have a couple more questions from the panelists, but I thought before we just hand it over, how do you think China's economy is going to track if COVID-19 is not suppressed by other economies, particularly its trading partners?
I think again we are looking at this. I think so if you look at how China open or gradually open up the lockdown domestically, it's in stages, in phases, but they actually give all the counties, provinces a code of your risk level. So for low risk level cities, personal travel are completely open, but certain areas, if some of the local counties, a few of them start to have cases resurging, again the rest country kind of block them out. I would think over time they need to do that internationally. I think the first one, they need to figure out how to reopen with Macau, Hong Kong, and Taiwan. Because all those places have very few cases, but at the moment we talk about, like in Hong Kong, the longest distance to travel is to go to Shenzhen. It takes 28 days because we each needs to be quarantined for 14 days. So again, I think if, as you said, if we look at the global map, if certain countries would just have every day a run rate of 20,000 new cases, I would think China would not reopen to them. The risk is too high. But I think the first phase of opening, they need to figure out what to do with Macau, Hong Kong, Taiwan. And second phase is, or they have already actually started with Korea and Japan. Even maybe Australia. I haven't noticed your cases, but
let's hope so.
Yeah, so and I think there are talks about even opening up with some European countries. Again, give the large population in China and given the cost they have taken to get rid of essentially this virus, they will be cautious, and they will look at, they have to assign each country a different code.
Thank you. Look, I'm going to stop questions now, and I'm going to hand it back to Mark and others for closing. Thank you very much.
I think we might be handing over to David, actually, but thank you very much, Dr. Liang, for a fabulous answer to those questions and a combination of both philosophy, policy, and also the detailed monitoring of the economy that your group is doing. So certainly from my point of view, I wish you the very best in your new role, which I think is very exciting, very well known to us down here in Australia, and we look forward to staying in touch with you. But I think I'm handing over to David Olson, I think, to say a few final words.
Thanks very much, Mark. And Dr. Liang, thank you so much for such a fantastic presentation. When Mark opened this session, he said that how China recovers its responses to COVID, is of enormous interest to everybody outside of China. And I think, that is absolutely a clear statement. We've only had less than an hour now, but we've had a massive canter through a whole range of the issues that China's facing. And it's been quite insightful to hear China's experiences and how China is responding to this. I think for many of us that are not actively involved in the financial markets in China, we don't get a sense of just how much activity is actually going on. And I know we haven't had time to cover a lot of things, but it's quite clear that there's extraordinary innovation continuing to take place in China, extraordinary liberalization of the markets. Stan just touched on the question of the Greater Bay Area. I was just looking the other day at 26 odd new policy statements in relation to how the financial services sector can be used to support the development of that part of China, and importantly, how does Australia fit into that's a big question. So there's a massive amount of information we need to have. It's been a real privilege to hear your insight from your position within CICC, and as you continue that forward in other new opportunities, we look forward to maintaining that interest. I'd like to thank Mark for his deft hand in delivering the questions. I thought, Mark, you covered the key areas. It's never enough time to go into it in great enough detail. Stan, thank you for your enormous support in convening this session, along with Mark as the chairs of the ACBC China Capital Markets Group. This is an incredibly important conversation. I hope we can keep it going, and I hope that there are many other opportunities we can deep dive into some of these great points. I'd like to thank Virginia and the ACBC also for hosting this session, to Austrade for their ongoing support for the closer relationships between our two markets, and encouraging from a business perspective our deeper engagement. That's really, really important right now as we try to manage some difficult diplomatic and political environments. So that's great. I'm sure there are many more questions that have lined up. Hopefully there'll be other opportunities to answer it, but once again, to everybody, thank you all very much, and to our participants who are listening, thank you for coming along and listening to this session today.
Thank you.